Understanding taxes and the economy. To understand the impact of taxes on the economy, you must first understand the trade-offs that occur in a modern economy. On the vertical axis, we'll reflect prices from high to low. On the horizontal axis, we will reflect quantity or jobs from high to low. A typical demand curve reflects the trade-off between customers willing to buy few items at a high price and many more items at a low price. The supply curve is just the opposite, where manufacturers are willing to produce more at a high price and little goods at a low price. The intersect is what we call the marketplace. Now let's consider this supply curve as the supply curve for foreign governments. Foreign competitors come from governments that are funded via a VAT tax, or value-added tax. A VAT tax works like this. A manufacturer, say like a miner, will be charged tax on the services he produces when he sells to a manufacturer. The manufacturer will be charged tax on the goods he produces, but can deduct the taxes he paid for the miner. Distributor, the same thing, charges tax on services, but can deduct taxes from the manufacturer. Ultimately, the end consumer, domestic consumer, pays taxes for the miner, the manufacturer, distributor, and is able to deduct nothing. Import goods share the same tax burden as domestically produced goods, thus giving equality. Now transform the domestic buyer into an export buyer, and his sales are taxed at zero, giving the foreign competitor a significant competitive advantage. Now let's take a look at domestic supply. Domestic supply has a natural gap between us and foreign suppliers, predominantly made up of wage rates and government regulation, offset by automation and entrepreneurism. Domestic supply, we fund the government via an income tax. The major inputs of supply are all taxed. For example, capital, which refers to rent, factories, and machinery, are also taxed for those that provide the services. This embedded tax forces out the supply curve, making it less competitive for domestic suppliers. Next, we'll take a look at labor. Labor is also taxed, both on the supplier of labor, after all, who can forget FICA and FUTA, and the company who employs the individual also pays a tax. This increases the cost of labor and thus pushes the supply curve out even further. Land, which is the last element of production, refers to materials. Everybody in the material channel is also taxed. This tax gets embedded and further pushes out the supply curve, making it more expensive for domestic producers. And finally, we have the entrepreneur, who is paid through profits. And of course, we all know that there's a tax on profits, pushing the supply curve out even further. The gap between the foreign competitor that comes in at zero tax and the domestic competitor is almost 30% in additional cost, or 23% of the total cost of the product, and thousands of jobs. What is the solution? The consumption tax. Consumption tax works very similar to that of a value-added tax, with some less complication. It taxes both foreign and domestic production at the same rate, thus narrowing the disadvantage produced by an income tax, or eliminating it. Some of the pros of a consumption tax are as follows. Those at the poverty level would receive a rebate up to $3,600 to ensure that they did not carry the burden of the consumption tax. Also, education would be tax-free as long as they reduce their costs up to 30%, thus reducing the cost of higher education or human capital. Existing home sales would also be tax-free. Sorry, mansions would not be. When it comes to personal property, used automobiles or used materials would also be tax-free, but unfortunately, again, Ferraris would still need to be taxed. 401k earnings and new stock issuance would also be tax-free. We would tax wealth, not productivity. Therefore, the tax on business income would be zero. The tax on jobs would be zero. The tax on personal income would be zero. The tax on exports or jobs would be zero. We would tax both domestic production and foreign production at the same rate, as opposed to foreign competitors having a significant advantage. Imports and exports. Tariffs, free trade must be fair trade. The U.S. has the largest market in the world, and that is worth something. We must maintain control over our trade, and cannot rely on outside entities to do this. Some example of tariff rates. 5% for those countries with near perfect competition. 10% would be kind of the standard import and export rate. And for those trader companies we would introduce the ability to not only tax countries, but companies that behave poorly. If you'd like to learn more about consumption taxation, please visit us at resoluteprinciples.com.